Good evening, dear traders. Today, US dollar against Japanese yen observation. So, US dollar against Japanese yen remains in an extremely important and at the same time dangerous zone for dollar buyers. The key story here is the 160 level, which the market has repeatedly treated as an area of elevated risk. Now let's talk why. Previously, this exact region triggered sharp downside reactions following intervention actions from Bank of Japan and strong signals from Japanese authorities. Because of that, the market clearly understands that the Bank of Japan is highly uncomfortable with a sustained move significantly above 160. And the reasons are quite straightforward. A weaker yen increases imported inflation, energy and raw materials costs rise, pressure on domestic consumers intensifies, and Japan's economy remains highly sensitive to aggressive currency depreciation. This is why every attempt by US dollar against Japanese yen to aggressively rally toward 160 is accompanied by increased cautions from market participants. At the same time, fundamentally, the US dollar still maintains an advantage. The US economy appears more stable. The Federal Reserve interest rate remains significantly above Japan's, and specifically with this situation with rising oil prices. And carry trade demand continues to support the dollar. In other words, the broader market still favors buying US dollar against Japanese yen, but the closer price gets to 160, the greater the risk of regulatory intervention becomes. Technically, the market is currently consolidating just below this dangerous zone. Buyers are still holding the structure. There is no deep bearish reversal yet, but the market is also not showing aggressive continuation higher for now. Essentially, US dollar against Japanese yen is currently balancing between the fundamental strength of the US dollar and fears of new intervention measures from Japan. That is exactly why the 160 zone remains the key pressure point for the entire US dollar against Japanese yen in this pair.